James Abate, you're a fan of IBM. This stock has really underperformed the S&P over the past year. It's down around 8% versus a 23% rise in the S&P in the past year. Are there some deep problems with Big Blue?
The problems with IBM are essentially endemic of what's going on in the overall economy. We like IBM, we own it in the fund, we see profit margins continuing to improve, and they're essentially holding back on major investment though in the business, which is being redirected towards share repurchases and dividends. If you just look at last year, IBM generated about $30 billion in free cash flow when you adjust it for R&D. They used 50% of that cash flow to buy back stock or basically to pay it out in terms of dividends. Only about 1/3 went to reinvest back into the business for R&D and capital spending. And you contrast that with 10 years ago, IBM only used about 1/4 of its free cash flow for repurchases and dividends. And the irony is that actually the dollar amount that they spent, about $10 billion for R&D and CapEx 10 years ago, was about the same as they spent in 2013.
So you see good things ahead for IBM. What about Tiffany? Now you value stocks according to EVA, economic value added. Does that take into account some rotten, really cold weather?
Well, you have to look further out than just what's happening in New York in January and February, that's for sure. But that being said, if you looked at margin expansion as being a driver of the stock's future performance, right now gross margin for Tiffany is around 57%. Normalized, that should be around 60%. So you're looking at about 3% of profits that are going to drop to the bottom line. A lot of that has to do with the fact that silver, which is their major input, went down dramatically last year vis-a-vis the prior year. So you'll start to see an improvement in gross margins, and obviously they weren't able to take any price increases last year because of the softness in the economy. New designs and so forth should give a boost to the top line as well.
All right, and then finally you're a fan of Google. Now you like mega caps because you say they're cheap compared to small and mid caps. That said, Google's trading around 7 times sales. Seems pretty pricey to me.
Well, you contrast it with Yahoo, which I think is an inferior asset. That's trading at 8.5 times sales. So when you look at the overall market in an environment where companies like IBM are holding back on capital spending and so forth, so I think we continue to go through this environment of we've recovered from the recession, but we don't yet move to what they call escape velocity. You have a company like Google that can continue to put up good profit margins, continue to grow, and it isolates an anomaly in the market right now that's a great opportunity. If you look at the largest 100 companies in the marketplace, they're trading on average at around 16 times earnings. Small cap companies are trading around 20 times earnings. So those companies, obviously small companies, have a very high expectation of a robust, improving economic backdrop in 2014, 2015. And when you add up sales growth and earnings growth for the fourth quarter, it was only around 5% on earnings, 2% on revenue, but earnings expectations for 2014, 2015 kind of bake into the cake a 20% growth rate.
So we're going to go with the big guys like Google, IBM, and Tiffany. Thanks a lot, James.
Thank you, Greg.
And thank you for watching The Street.